But the question is coming up that, you know, how can we determine where the market's going to draw to next, and what are we doing with these wicks? Why do I pick this one wick over another? And I kind of like want to drill that home today, so that way it'll help you. So when I'm looking at price action, okay, if you're not going to pay attention to this kind of discussion, if it doesn't interest you, if you don't like going into the details, I promise you everything that you study under me will frustrate you. It's not meant to be easy because it's very technical. But what I'm going to explain to you here is very generic approach to every single time I'm looking at price action. My mind frames out a specific area in price action. See, when you look at this chart, you're looking at all of these candlesticks and you're looking back. You're like, okay, where's there a fair value gap in here? Where's there relative equal highs? Where's there a wick over here? I'm not doing that. I'm not doing that at all. That's not what I'm doing. So what I'm doing is I want to see, okay, first, if the data range is 20 days look back, okay, so what would that look like? What would that constitute as a beginning and ending point, so that way you have a very easy framework to start and hit the ground running this week. That way you can go and start using this information yourself. We're on Saturday, okay, it's October 18th, 2025. It's a Saturday. The markets are not trading unless you're a crypto freak, and I'm not trading crypto, so I could care less. So this is looking at the close on Friday, okay? Count that day as one. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So right here, September 22nd, that's 20 days look back. Now, inside that range of 20 days, what we're going to look at is the highest high and the lowest low. Very, very simple. It's not complicated. It's not ambiguous. It's very specific. So what would that be? This is the lowest low, and this is the highest high. So in deference to those two price points, there's the 22nd, and the candle right before it's the lowest one in all of these ranges up to that high. This is the lowest one. So all you're going to do is drop a box on that, anchored up there, and this is just for visual representation. You don't need to do this because it's just lipstick to help me communicate something to everyone that's watching. But inside this range, that is my 20-day look back. That's all I ever need. I don't ever need to look to 40 days or 60 days. Now, if you're in a market that's running, for instance, like gold, and we'll talk about gold in a little while. But if we're looking at just tell me what the market needs to be focused on right now, what PD arrays are going to work right now, which one's the central focus, what draw on liquidity is the ones that I need to be worrying about right now. Give me the right now skinny ICT. Make it short and sweet. I ain't got time. I'm only 20 years old. I ain't got this all the time in the world to learn all this stuff. Okay. This is what I'm looking for right here. This is my bread and butter when I'm real quick, kind of like sitting on the sidelines, waiting for something to pop up. My go-to is this. So I want to go back over the last 20 days. If it's a market like gold, I almost went over this without saying it. If it's a running trending market like gold is, okay, or silver, something like those markets where they're going parabolic, then I'll go back 60 or 40 days and I'll get the range there. Okay. And what I do is I want to see where are we in relationship to that range. Now, obviously, right now we're in the premium side because we went down to discount below. Here's this dark line here. That's 50% of that line. And you get that by having this middle line toggled on the rectangle tool. I don't mean to bore you, but I get a ton of questions. So I kind of like want to take these moments to put that kind of stuff in there because hopefully it'll reduce the number of questions I get that are repeated or redundant or seeming very elementary. And some of you guys get really offended when other people ask questions like that, on on X. And it's almost like you're creating an atmosphere where no one wants to ask a question, which that pisses me off when I see that. So remember, you didn't know this shit the first time you sat down either. So at this line or above it is premium, or at this line below it is discount. Okay. So having all these reference points inside this range available to me, I first start fresh by looking at where are we in the range of that segment of price action. And I'm gonna okay, I'm just gonna plot it over top of this. It's already got a lot of stuff on it now, but just bear with me, okay? And everything will be in a black, bold line. It's going to represent the grading of that 20-day look back. And again, this is for everything that I would ever want to trade. If it's Forex, if it's stocks, if it's commodities, bonds, index futures, whatever. Okay, whatever I'm doing analysis on, this is the very first thing ICT does. The very, 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 very first thing. Okay. Part of the things that I have written down, hear that? This is that little yellow notepad I tell you I always have. I have these levels when I'm looking at a particular market, or if someone prompts me, hey, look at this, the first thing I do is what I just did here. I grade the price swing or the range of the last 20 days. And then making sure that I have the full grading levels. By having this, it tells me where I can focus in on very high probability shifts in market structure, where it can draw down to as a retracement, and what PD arrays lie inside of each one of these quadrants. Because every one of these quadrants also can be graded. So that way you have a 20-day look back like this. So here's upper quadrant, like not the highest upper quadrant, but this one here, but it's in a premium. Then we have equilibrium, and in the lower, below the midpoint equilibrium, but not the lowest. So the extremes, when we get into these areas here, when we have a 20 look back that's bullish or has been moving higher like that, unless I'm expecting a complete reversal or basically a bear market resuming, I'm not looking for anything in this lower area down here. My focus is going to be primarily in this area here and this area right in here. All the setups, all the things you're going to look for that are many times just actionable PD arrays that you can just get in there and just take a trade on intraday. 15-second chart, 5-second chart, 1-minute chart, 5-minute chart, 15-minute chart. You're going to see all kinds of busyness available to you as a short-term high-frequency trader. And forego the idea that it needs to get down this extreme lower quadrant. Okay, and I'll give you all the boring details about that, at another time, because if I did that here, it would fill the whole hour up. But this is what I'm doing, and I have these levels by price: 97.215, 97.802, 98.389, place, so forth. I have that written down on my little notepad. Okay. Now, inside of all these quadrants, there's going to be PD arrays. Okay. And those levels with their respected grading levels, I have those in order. So inside this little notepad, on whatever page I'm looking at, like right now, I have NASDAQ. This is the one I'm focused on primarily. If this were dollar on my pad, and I want to share everything that I want to give to you, is not everything on my pad, because I'm not hiding anything from you, but it's just, I want to keep things personal, you know what I mean? And I don't feel comfortable sharing everything. You don't need to know every detail, but I am telling you what I'm writing down. But every PD array in here and its respective quadrants, like this wick in here, I would have that written down below this price level here. So we're looking at this range here, and inside of this portion, okay, 75, 50 to upper 25%. That is where the heart or the core of most of everything you're going to see that's useful to you, it's going to reside inside that. So that way you can ignore this area for now until it comes all the way down to the lower quadrant and breaches on a closing basis. You need not concern yourself with anything down here. That's how I'm interpreting price action using a 20-day look back. So I'm focusing primarily on just this bit of business in here. Okay. So with that said, we're going to remove this now, and I'm going to remove this box and go back to what I had here. Okay. So now you know what that looked like. I'm not going to give you a PDF of this stuff. So the way you can do is watch the video, pause it, and then do a screenshot. Okay. And there's your equivalent to what I would be putting in a PDF. I don't have the time today to do that. I don't mean that to be curt to anyone, but everything that would be done in a PDF file, you can gather it from this video. Okay. So we were up here, and I told you if it went down to this level here, then it would offer the opportunity for NASDAQ to go higher. And when we're up in this level here, using that idea that showed you on the 20-day look back, it allows you to frame a very specific segment of price action. So your focus is narrowed to what is the most salient range of price action that the algorithm is going to refer to at the moment, 20 days look back. By grading that, you can see where the upper quadrant and the lower quadrant, in deference to the equilibrium price point, inside that little area, or maybe not necessarily a little area, it could be a broad, big area, but inside that smaller portion of the last 20 days look back in dollar, all of that is going to be the heart of what the market's going to utilize. And you need not concern yourself with anything beyond that. So do you see how right away we're already reducing the argument down, okay, and distilling the principle of focus? When everyone outside of our community, they'll say, well, this stuff doesn't work. It doesn't make money. You can't use it. It's not predictable, and there's too many of them, and there's a lot of them that fail in terms of fair value gaps or PD arrays. By limit your focus to the upper quadrant and the lower quadrant in the last 20 days, whether the market's moved higher or lower, you are now focusing in on where every single one of the high probability PD arrays are going to form. Do you see the advantage in knowing that now? Every single time you sit down in your charts, and what will be interesting for you is by you going back and back testing. How would you do that real quick before I go on further? Let's say that you were doing this, okay, and you look back. This was the 20-day look back range here. But you want to do another research approach to it. Well, just move further over to the back of the old price data and just pick any random day and start there. Say, okay, I want to do a case study here. Let's say I was looking at price action here and count that as day one and go back 20 days and frame it and grade the range from the highest and the lowest, and then see where you're at and look at the upper quadrant and lower quadrant. And you're going to see everything that's being used is inside those very specific ranges. So that's what the algorithm's doing. It's cycling through on a daily chart in that range, highest and lowest, because it's an algorithm. That means it has to go back to a very specific data point. By having the reference to time, we can look back 20 days, highest high and lowest low, and then frame where in that range the algorithm is going to focus on primarily to use specific data points. On a daily chart, every individual day and its open, high, low, and close is a specific data array. It's a reference point. Now, what do you think happens when the algorithm is looking, when we're up here? It's going back through all of this range. And we knew that this area in here is essentially the upper and lower quadrant, not the lowest extreme quadrant and not the upper extreme quadrant. It's just the middle part, okay? While it's up here, and if it's going to go back through every individual candlestick, it can determine, like this candlestick here. This is a premium wick when price is right here. If it's going to reprice lower for the purposes of allowing other markets to go up and create a risk-on environment and trade to a deeper discount on its individual daily range, it would not use this candlestick premium wick because it's already below it and it plans to go lower. It's generating more delivery to the downside. So it's going to ignore this candlestick wick. But what will it do with, for instance, this wick? This is a premium wick too. Let me move it over so you can see it. See that? So this candlestick's high is delivered with a small little wick. I want you on your own time, take that wick right there and project those quadrants all the way through and look at every small little time frame, see if there's any rhyme or reason to why price maybe abused any of that. Then the next one after this candlestick going to the left, in the look back of 20 days, it's going to be up here and then looking, oh, now look, this candlestick has a daily high and then its close is way down here and its open is down here and its low is a tick or so below that. So you can see visually that there's a long wick on the top end, right? So the algorithm is going to take that entire range of that wick and what's it going to do? It's going to grade it. With that idea in mind, all I did was shrink down the daily chart. The open, up, and high. You don't need to be able to, I guess, have the 25 and 75, where they're at, if it's the high end or the low end. In other words, I'm just real obsessive about it. If it's a wick that goes up and it's a premium wick on that individual candlestick, I always take it from the close up to the high, regardless of wherever I'm using it in terms of a discount or a premium draw. I'm just real anal about that because I have to have these levels on my notepad the right way. And by having them written this way, where it has the 25, the 50, and the 75 here, by having it that way written on my chart, or not my chart, but on my piece of paper, I don't have to have it on my chart. I'm looking at it by its label, its little annotation written next to the price level here, like 93.306. I know automatically because of the orientation of 25, 50, and 75, it is a premium wick. So I don't need to write that part down. You see how I'm saving myself shorthand? I'm saving myself longhand writing in notes with shorthand ideas by referencing that. Okay, so referencing specifically if the 25 is the higher quadrant or the lower quadrant is what I'm referring to. And if it's the higher, then it means it's a premium wick on that individual candlestick. And then projecting those quadrants forward, watch this chart over here. Okay, because these levels are going to end up populating over here, and you're going to see a whole lot of things that never were noticed before. See them over here. Now they're showing up over here. Now watch. The algorithm right up at this day, the rules I told you is if it goes down below consequent encroachment and goes below this individual candlestick low, then NASDAQ's going to go higher and dollar will want to go trading lower. And then we'd have to worry about going into this inefficiency and worry about this wick here. Go back and watch recordings. Okay. Don't take my word for anything I'm saying because I could tell you anything. I could blow smoke up your ass. And most of you would say, wow, ICT said, this, that, and the other thing. So I don't have to do any of that stuff. I can just take what he said and that's all I'm going to do. Just believe what he says. No, don't believe anything I'm saying. Go out there and test it and see it for yourself. Because when you see it in your own charts, you don't need to have to worry about wrestling the idea or defending me on social media for people outside our community. So when we anticipate a market potentially going into a shift higher after it trades down to a deep discount here, we went right down into this level here that's 50%, in case you're wondering why this did this. This little 50% line is half of this inefficiency right here from this candlestick's close and this candlestick's open. That's what I've highlighted and shaded. That's the suspension block. When you put the rectangle tool on, again, as I mentioned before, make sure it's top. Well, is it? It's not, is it? What is that anchored to then? Well, it's essentially the same thing. That's what it should be showing. I'm not sure. My eyes probably have it anchored to something else. But there it is. You can see that it's highlighted a little bit darker now. But this indicates that we're in a deep discount and we're inside of a daily old inefficiency and the market's traded down. And then now we can start studying price to see if it wants to give us a tip of the hand, kind of like show its cards to us by wanting to go higher. And that's going to be in the form of a market structure shift. You can see the bodies are respecting. We've got a little bit of a wick in here. And then we have that short-term high formed right there, right on top of the low of this candlestick's premium wick. That's this candlestick's closing price. This short-term high, when it pierces through that, that's a shift in market structure. So when price pierces above this wick high, why am I picking that one? Because after this low formed, it started going back over top of this lowest quadrant, and it pierced a swing high in price. That's this candlestick right there. See that? So let me make it a little bit broader. There you go. So when it traded above it right here on this candlestick, we want to start seeing what? Bullish order flow. Algorithmic order flow has no requirement of any gimmicks, no level 2 data, no volume profile, no volume analysis, footprint. It's all bullshit. Okay, it's fucking bullshit. I can't say it plainer than that. Okay. Now I know somebody's going to come in and say, "Look at my broker statements. Look at what I did. Look at my did here. Look at what I did." Okay, wonderful. That gets back to the same thing. You have a religion. You placed all of your faith in trinkets of deceit, because that's what that bullshit is. There's no different between that and RSI, Bollinger Bands, whatever. This is technical science. It's all time and price. Nothing else. There's no fluff in it. Time and price. That is it. When price trades above that swing high, we want to start seeing price do two things. Okay. Every down close candle supports price. And I'll explain what that is in a minute. And we also want to see it respect the quadrants. Price goes above, the bodies come down here, but there's a little piercing on that candlestick right there, the wick, and right there. Where are the bodies? Are they above the lower quadrant, or are they allowed to go through it and trade below it? They're above it. Big, 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 big indication right there. There's no settings that you need to tinker with, no optimization of my bullshit. The market's optimizing. You don't need to change any fucking settings on any indicator. The candlestick bodies are staying above it. So that's giving you the narrative that we are now in bullish order flow. Do you need a depth of market, volume profile, footprint, level 2 data? Do you need any of that horseshit to see what I just said right there? You can see it only in price track, the price charts. It's a time-based open, high, low, and close bar. You can't get that information from a range fucking bar, Ichimoku, and any fucking thing else that you want to contrive or construct. It's stripping the advantage. It's stripping it. I don't give a fuck how many schools of thought that you apply to your analysis. Elliott wave, fucking ratio trading, regular candlestick shit, GAN, Gartley patterns. You can keep throwing all the dog shit against the wall all you want. Something will stick eventually, but it's still going to stink the high fucking heaven, because ain't no way that I would ever use that stuff. It's ridiculous. This is all that's necessary to understand what order flow is going to do. It tells you when it should start being bullish. It tells you how to trust that it's being bullish, how to identify it. The bodies are saying we're not going to go lower. So start watching down close candles. Do down close candles support price? Because that's my order block. My order block is not fucking orders. I have so many people on fucking YouTube literally running around saying, yeah, because an order block is a bunch of orders. Bullshit! That is not what the fuck my order block is. That is not what that is. I specifically fucking taught it the very first time. It is not anything to do with orders. The word order is that it's ordering the change in the state of fucking delivery, okay? That's the technical fucking term. That's exactly how I'm going to fucking say it in the book, with the F words included. It orders. It coordinates. It has nothing to do with buying and selling orders. Fuck you guys, man. You're stupid when you fucking out there creating your other extra bullshit. And whatever I taught, anybody that adds to what I'm saying, fucking drop them. Get their fucking asses out of your timeline. Don't even pay attention to them. Because I promise you, they don't know shit. They don't know anything. This is perfect. It's purity. It's perfect. And you start messing with it, you lose its perfection. Watch. Down close candle right here. See that? What we want to do is visually represent, in my mind, I'm looking at that opening price and I'm carrying it to the right. Let me make it blue because it's going to not stand out. I want it to be popping on this chart versus the other black lines. It's very disorienting for me because I have all this shit on here, but I'm hopefully communicating this well to you. Two things you have to primarily concern yourself with. Fuck the level 2 data shit. Fuck everything else. Fuck all your gimmicks. Okay. Everything you need to know is time and price. And by having these quadrants on your chart, or at least knowing what they are, then what you're doing is when there's a potential shift in market structure, how do you know it's a shift in market structure, Michael, and not just a retracement that's going to sell off later on? Watch. Watch. We're in a deep discount on the daily chart over here. This thing should, even if it's going to be a short-term bounce, it should at least make an attempt to rally outside of this inversion fair value gap. In and of itself, that's enough to take a trade. That'll give you 10, 15, 20 pips in pound dollar, euro dollar. Go and look at the charts. It'll be there. But looking at the down close candle, it's the lowest one, not just this one. This is lower. That's open is lower than that one. It has nothing to do with the number of orders. No buying and selling orders have nothing to do with this. That opening price is the change in the state of delivery. The order, the word order, is going to order, it'll create the systematic shift in price at that level, at that fucking price, that one. That's what you're looking for. When price is dropping down into it, like right here, okay? This candlestick's opening price is 98.143. And this candlestick's 98.142. It's off by 1/10. And it's the dollar index, which is shit. It's a market that's not real pure. Dollar's always got this weird, quirky bullshit to it. But when you use it with an index like NASDAQ or S&P or Dow or Russell 2000 or bonds or Forex currencies or currency futures, hello, you're gonna see me trading some currency futures here before we get into Christmas, and I'm gonna use the same shit there. It ain't gonna be in Forex. It ain't gonna be in NASDAQ. It's gonna be in index only for right now. But I'm gonna do some currency trading with currency futures, and you're gonna see it's just as precise there too. It's not a one-trick pony. This stuff works in the DAX. Okay, it works in the FTSE. Stop emailing me and asking me these things I've already said before. It works in all of those things. It works there. I promise you. But watch what happens when it trades down into that. And then now what's it going to do? It orders what? The change in the state of delivery. The block of time, that's what the part of the word block is, okay? That block of time sets and establishes the order in which price will change its state of delivery. That is the real definition of my order block. And find that fucking shit in any other Mickey Mouse stuff. It ain't out there, folks. It's not supply and demand. Ain't no fucking way this is resembling anything like supply and demand. Oh, it looks like supply and demand. That's because you're an idiot. Study it. You'll see. This is fucking light years. It's rocket science compared to marbles. You're playing fucking marbles with supply and demand. You're guessing. You have no idea what the fuck you're doing. Demand the fresh zone. There ain't nothing fresher than this. Piping hot and fresh. And the market starts going higher. Now watch. We go above this lower quadrant. Okay. Big shift. Okay. Big shift is coming. Are we seeing price come back down to that quadrant level? Yes. Does it wick through it? A little bit. And that's permissible. But this candlestick, this candlestick, this candlestick, this candlestick, this candlestick, that is a block in time. You pay attention? Do I need to play some fucking rave music to get you hyped up now? Dance around, look like a fucking idiot. That opening price is the order block. That's the change in the state of delivery. That price, carry it forward. borrow this one. We rally a little bit up here. We fall short and start to break lower. This is the next draw, but it's going to drop back down into this order block. All of these consecutive candlesticks is one order block. Now, when you have a series of down close candles, you can go to the lowest one and be very, very restricting on your selection of setups. You're asking for the best of the best. There's nothing wrong with that inherently, but it just means that you're going to miss some setups if you're only and always doing that. But when you have a range of candlesticks like it is here, let me make it a little bit bigger and taller. Should be a little bit easier to see now. You're welcome. So by having that open on that candlestick down to that close here, here is mean threshold of this bullish order block. So at this price point or higher, and this, none of this should seem hard. This is all basic ICT stuff from my YouTube channel. Like I'm not bending and twisting and contorting things to make it fit. But here is the upper quadrant, the mean threshold, the lower quadrant, and the low of that order block. All these consecutive down close candles, you have to consider the entire range. You can't just, oh, I'm going to only pick that one and expect to get every move. You won't. You won't get every move. And this is probably many times why you see these idiots on the internet say, oh, look at this. This is an order block right here. It never even went there. Ha, ha, ha. ICT's a fucking clown. Ha, ha, ha. Dude, you're an idiot. Like, this is what's going on. You grade it. You want to see it stay in what? The lower half for the best responsiveness and price action. Do you want to see it appear in the lower half of it or in the upper half of it? What do I teach with order flow using my PD arrays? When it's bullish, we want to see equilibrium or halfway mean threshold. You want to see consequent encroachment or up to the high of the PD array. When it's bullish, you want to see sensitivity in there. And when it's bearish, you want to see it stay in the lower half. You don't want to see it traverse down into this area down here. And since we can measure this, watch, here's a qualifier for you. This is going for the people that ain't here really trying to learn, this is going to go right over your fucking head. But for people that really want to know, I want to know that I know. Give me the details. I want to know every nook and cranny. Butter it all up. The open is right there at the equilibrium price point. So you're demanding it must go down halfway. What would happen if that opening price was down below that? It's even less likely it's going to trade to that as the order block. So now I just taught you, when there's a series of candlesticks that make up an order block, how do you use the information? This is how you use the information. Don't buy my fucking book, okay? Don't buy them. Don't buy none of my fucking books because I'm teaching you right here for free. Please stop listening to these fucking people saying I'm trying to get rich off of books. Why don't I have them out there on the market right now? I'm hot right now because I don't need the fucking money. And this fucking publisher is arguing with me. I want my cover to look the way I fucking want. So that's where we're at. And yes, I'm being a dick about it. I don't care. But it's not that I'm teaching better than the book will, right here. So it goes down to the upper quadrant here, wicks down and touches the upper level of that inversion fair value gap. So we're getting two things. It's using the order block. It's staying in the upper portion. In other words, let me take the lines off. The bottom one off, that one, and I'll take one. So it's inside this order block, it's this line and anything above. So this is the range right here. That's what you want to see it use. But it trades down and just touches the inversion fair value gap on the daily chart. So you're getting two pieces of information there. Yes, it's trading inside of this entire order block. It's permissible to do that. It could go all the way down to mean threshold, which is the halfway point at 98.171. And that's completely perfect. There's nothing wrong with that. What you don't want to see is trade down in the lower half of that. In other words, below this on a closing basis, because then your probabilities of seeing a price run higher, it falls off precipitously. You want to see it stay in the upper portion of it, from mean threshold up when it's a bullish order block. From the low up to mean threshold, the lower portion when it's a bearish order block. Okay, so those rules are pretty straightforward. All right, so I can take this off now. All right, and then we get the change in the state of delivery. It rallies back up, falls short of getting up into this wick here. This is a premium wick, but you can grade that and carry it over here just to save time. You do that on your own, but you want to grade that, see how it's being utilized over here. And then it trades right back down into the, was it upper quadrant? I believe it is. Yeah, it's upper quadrant of this premium wick. Now, right away, I already see some of you think, oh, this is a lot. I'm getting confused. Okay. Go trade with indicators. Because if you want to see how I'm doing what I'm doing and you really want to learn, this is what I'm doing. And it's already going to filter out a lot of lazy people. And if that makes you angry, if I offend you, I don't care, because this is not hard. What I'm showing you here is not complicated. I showed you how to determine the range, and then you look for all the PD arrays and the wicks. Inefficiencies and wicks is the two first things I'm looking for. And they're obvious on your chart. Not every candlestick is going to have a wick. Not every candlestick is going to create an imbalance. So it immediately filters out all the bullshit. Only things that are salient, that's what you're looking for inside that 20-day look back. Market reacts, comes back down to the upper quadrant. Does it respect it? Yep. Sends it off again. Comes back down, wicks into it again, little tiny coloring outside the line, but watch the body. This body stopped here. We opened here, traded down. When it trades live and trades down like that, you want to anticipate it do this very thing here. And you want to see this candlestick or immediately the one following that. In other words, say this candlestick closed anywhere but below this black line here, the upper quadrant. If it closed anywhere like that, the next candle we would demand, okay, because I supply, I mean, and I, you know, I demand, you know, respect for the stuff I'm sharing. That's the real supply and demand right here. The idea would be to expect the candlestick to start raging higher like that, because it's already showed a willingness to come down here a couple different times, and now it enters a macro. What time is that candlestick right there? Look at the bottom of your chart, or my chart. 6:50. Man, that's random. That is absolute fucking bonkers, man. The timing of that run off of that quadrant, after the shift in market structure, I taught you how to validate. You're in bullish order flow. All the things are sitting there telling you it's respecting the quadrants and down closed candles. See, here's the order block. Does it support price? Yep, it rallies. It's in it again here. It rallies off the quadrant, and then it tags it one more time, and now it's time to run. We're entering what time of the morning? 7 o'clock to 10 o'clock. That's the time of the day. I told you, every fucking day, it's going to lay it down on you. Here's the opportunity on a silver platter. Do you know how to find it? Between the last live stream I did, October 1st live stream, and today, you have now learned more than any fucking person can ever teach you about technical analysis with precision that they could never dream of.